Good morning, everyone. This is Amanda Field, the Executive Director of the RCAW, and I'm so happy to have you here. Join us for our RCAW's Lunch and Learn. I want to remind you that today's Lunch and Learn is being recorded and will be available to you on our YouTube channel in about a week. Hub is an exceptional employee benefits broker that can provide your business with a clear, concise path forward as your workforce evolves for a more personalized employee benefits program. Today, I'm with Linda Matos, account executive with Hub, and I'd like her to talk more about their benefits. So Linda, go ahead and take it away.
Oh, Linda, you're on mute.
Thank you so much, Amanda. It's great to be here today. And I have to say, I have enjoyed every activity and event that I've participated in with the RCAW. Everybody has been just so nice, and it's been a joy for me. And I know many of your members initially met Steve Roberts, who retired last April. Tracy had found Steve and had brought him in to help with the group medical plan. And so Steve brought in the Clean Tech Alliance program, and it enabled RCAW members to take advantage of the Clean Tech Health Insurance program, but not have to join Clean Tech because their membership at RCAW would allow them access to that program. And so many of you have heard a lot about the Clean Tech program. Many of you have your company benefits on Clean Tech. So I wanted to do something different this year for you because Steve and I were with Conover when we first met the RCAW, and Conover was absorbed by Hub International. And Hub International is a very large national and international brokerage, and we do all insurance from soup to nuts. I specialize in employee benefits, but Hub does many of the RCAW member commercial insurance as well. So with that, we wanted to move a little bit away from Clean Tech this year and just broaden our presentation to you, since Hub is has so many layers and a lot of resources for employers. And one of the big resources that we can offer because of our size are what we call compliance officers. So today I have invited Sonya Gordon and Darcy Turner to be with us today. And so when you come to me or my clients come to me and ask me for some kind of a compliance related question, like what is the Washington CARES Act? What do I need to do for COVID for my employees? There's a lot of rules and regulations around compliance, COBRA, for instance, that have to do with group medical plans. So in those instances, I turn to my expert team here. And so Sonya has a presentation just on some high-level compliance issues that are good to be aware of, that might be coming up, that are in place. And that way you have a face with a name. So if you have any further questions, I believe we're going to have somewhat of an open forum. You can ask questions while she's presenting, or at the end, or certainly afterwards, you can follow up with us. So with that, Sonya, if you'd like to share your screen or
Sure.
Take from here. Thank you.
Okay. Oh, host is disabled participant screen sharing. I can't share my screen. Shoot. Oh, there it is. Okay, thank you very much. Okay, just a second. All right. So really what I wanted to bring to you all today, first, I'm sorry, my name is Sonya Gordon. I am an attorney by training, but I work for Hub in a compliance management capacity for the main compliance officer for the Pacific region. So we do employee benefits and healthcare compliance work on behalf of our Hub clients anywhere in the Pacific region. So that's primarily California, Oregon, and Washington, occasionally Hawaii. So it's interesting work, and you deal with kind of the intersection of both federal and state laws, because as you know, especially in these times, the laws are changing and evolving fairly rapidly. So what I wanted to go through were some of the areas that we are covering often in our capacity. I won't be going too into depth on different areas, since lots of times these are things where we are helping on kind of an in-depth level. But just to give you an idea of where our services are most relevant for our clients. Those are nice pictures of me and Darcy. Oh, and Darcy, do you want to introduce yourself as well?
Sorry about that. I
All right.
mute myself. I'm Darcy Turner. I'm a compliance analyst here for the Pacific region. And I don't really have much to say about myself.
That's all right.
All right.
But Darcy is our researcher and presentation maker extraordinaire, and we could not do this job without her.
Thank you.
Yeah. Okay, so this seems like a long agenda, but believe me, this can be gotten through. We've done crazier things than this before. We'll be covering kind of the current state of the different COVID, both national and public health emergency statuses, and what that means for employers and benefits, some ACA reporting updates, the new transparency rules and No Surprises Act rules, and Washington paid family leave updates. And I don't believe there will be anyone in Oregon or with employees in Oregon with paid family leave issues to deal with. So we may go past that one. And then quickly kind of what to expect that's coming up in 2023. So COVID updates. One thing I wanted to let everyone know quickly is that so there's the public health emergency is in place still and has usually been renewed in 90-day increments. That is the emergency that provides, among other things, for plans to be covering testing and vaccines for COVID at no cost to a participant through the emergency phase. So while it is active, in-network coverage, in-network treatment needs to be covered without cost sharing for testing and vaccines and at negotiated rates. And what we're seeing right now is it looks like, since it's renewed on 90-day increments, that the public health emergency is likely going to be renewed again to January 15th, 2023. So whatever rates the groups may be dealing with right now in terms of covering those benefits will continue at these rates at least through January 15th, as far as we know. The other area we wanted to make sure that groups are aware of is it's so funny, there's both a public health emergency and a national emergency. The emergency declaration in effect is also the national emergency, and that at the moment is still in effect until March 1st, 2023, unless President Biden were to revoke it before that time. And one thing that does that's important for plan benefit purposes is that a lot of the rules and regulations are relaxed during that time. And a lot of deadlines that might normally apply under areas like COBRA or special enrollment rights, and I believe claims, are all extended an additional period of time. So, for example, with COBRA, if you have 60 days to elect COBRA after an employee's been terminated, they will actually have 60 days following the end of the outbreak period. So essentially, you're adding the outbreak period to any deadline. Now, before we had an idea that this might actually end on March 1st, 2023, we didn't really know when the outbreak period would be ending. So that was usually going to be a year at the most, plus whatever the number of days were given. But now, since March 1st is less than 6 months away, this really doesn't tack a whole year onto the deadlines the way it used to, at least not without us all knowing more about how this may work out. Sorry if you hear a lot of dogs barking in the background. There was the dog pickup worked just fine, except I hear lots of barking, but I hope you don't. Anyway, so this nice chart kind of gives a good summary of some of the areas where it's extended. Election, COBRA election, the initial payment and subsequent payments would have the outbreak period extension, although that doesn't mean you get like an outbreak period on everything. You wouldn't, I mean, that could tack on years to like making one COBRA payment at that rate. Same with HIPAA special enrollment rights. This doesn't cover every qualifying life event, but if it's one that incurs a HIPAA special enrollment right, you'll have the same extensions, such as loss of other coverage, acquisition of a new dependent, as well as marriage or divorce, or becoming eligible or losing eligibility for state assistance. Those would also add additional time with the outbreak period under the normal regulations. Also, another area that's affected by the declaration would be ERISA claims procedures. The timing that's usually in place for initial claim filings, appealing a denied claim, external review, and submitting additional information, those have their own separate deadlines under ERISA claims, and the COVID-19 rules allow the outbreak period to occur before those deadlines would occur. And that is when you would determine if it was filed on a timely basis. And let's see, I do not see any questions, so I will move on. Darcy, is there anything you would add that I may not have? I mean, this is still like big picture overviews of the state of the state.
Yeah, I just wanted to say that a lot of employers have a COBRA administrator in place if you have more than 20 employees.
Sure.
Or even if you're on the clean tech, you would be subject to COBRA because you're even with less than 20 employees. So Sonya, in that case, kind of the slide that you just told us in terms of COBRA, that would be the COBRA administrator would be aware of that. Okay.
They certainly should be.
Yeah.
One issue that we've seen is, I mean, this is not a new issue anymore, but it hasn't really gone away, is the fact that what's an employer supposed to do while they await payment? You know, because at one point that could take up to a year. At least at this point, it may only be about 6 or 7 months. But what we found is there are some administrators who have taken a position early on that they will terminate a potential COBRA elector's benefits the way they would normally, you know, the way you might terminate a recently terminated employee's benefits and then reactivate them once they've elected and paid. So that if a person has elected but is taking time to make that payment, I mean, that's fine, they're allowed to do that, but the benefits are terminated and then reactivated once they've paid. So it may be worth looking into what an administrator is doing in that respect, or how they're dealing with that sort of issue.
Got it. Thank you.
Yeah, sure. Okay, I wanted to talk about ACA updates reporting and IRS enforcement. I was told that this group has a mix of different sized groups. So actually what I should have asked you, Linda, is the Health Tech Association plan itself, are they the ones who do ACA reporting then?
They do for members who are on the Clean Tech Association plan, yes.
Okay. And do you know, well, I guess I'm just wondering about what kind of share of people are on clean tech versus not on it?
So it's all over the board. I mean, clean tech was one product that we brought to the association, but of course, we're not a captive broker, so we may have also brought Kaiser or Regions.
Okay. All right. Yeah. And sorry, not trying to, show favoritism or displeasure or anything like that. I just want to know if it's something that anyone would be dealing with directly in terms of the ACA, because it's possible they would not be. Well, anyway, I'll just give you an idea quickly of some of the issues that, for those of you who may be handling ACA reporting, or your staff may be, what may be lying on the horizon. So for those groups that are responsible for reporting their employee coverage because they are an applicable large employer, as you know, you've been doing the reporting since 2015 for 2014 going forward. And as you may or may not know, the IRS was sort of allowing a good faith effort to pass for various mistakes that may have been made in the reporting. Unfortunately, that is ending for the 2021 reporting. Actually, it ended with 2021 and what was reported in 2022. So what they've indicated is they will not be allowing a good faith effort for years after 2020. So accuracy and timeliness is going to be very important for the forms that you'll be filing next year. Don't forget that there are many penalties for returns or statements that a failure relates to, 280 per return or statement. And it could apply separately to failing to send a statement to the employee or failing to report to the IRS. Now, the good news is some of these penalties are reduced if they are corrected quickly, namely the 30-day rule. So if it's corrected within 30 days after the filing date, or it's reduced to $50 per return, and it's capped at $571,000, or a bit less than that for a smaller entity. Or there's an August 1st rule where it's corrected within 30 days described above, but on or before August 1st, it's reduced to 110 per statement. So, I mean, there are small favors here, but still, these penalties can add up very quickly. So if you are a group that is responsible for ALE reporting, while I know it's not a new process, it is one to make sure that it is getting done accurately and timely. So some areas to keep in mind where one needs to be accurate on top of everything is ensuring for the ALE applicable large employers that you're providing affordable employee-only coverage. And what you're reporting is sort of regardless of what your employees who are eligible and what they elected, you're reporting what the lowest cost plan was for an employee only. And you'd be reporting the one that has minimum value. And in this case, you also need to show that because that it was affordable and met the IRS safe harbor. So used to be that the safe harbor was 9.61% of an employee's income for 2021, and that decreased to 9.12% based on one of these three safe harbors. First is the rate of pay. This is fairly straightforward, is you take someone's hourly rate of pay times 130 hours times 9.12% to determine what the maximum monthly contribution would be towards their benefits. The other one is the federal poverty level, where they base it off of poverty level wages, but that obviously can result in a very low calculation. So that is not going to be the easiest one to use unless this is sort of a low wage working group. And the last one is the W-2 safe harbor, where you use the box one of the employee's W-2 earnings for that calendar year, so not the prior year. So you're using projected 2023 income to determine it and determine their rate of pay. Now, because W-2 is a projected figure, what ends up in box one may not be the same amount of money as what you think someone's gross pay is going to be, from your own records. So generally speaking, HUB does not recommend using the W-2 amount because that can vary so widely. And usually we advise employers to go by the rate of pay to calculate whether the contribution employees make is affordable. Now, which employers are impacted by this decrease in the safe harbor from 9.61% to 9.12%? It's again employers who are applicable large employers, and those are ones with 50 full-time or full-time equivalent employees in the prior calendar year. And it will apply for the calendar year plan. It would apply beginning January 1st, 2023 for a calendar year plan. But if it's a plan renewing after January 1st, it's going to be the first day of that renewal in 2023. So if you have a July 1st renewal, then you don't need to worry about this affordability decrease until July 1st, 2023. And as a nice resource here, there's a good thorough article about each safe harbor that I have linked here. We can share that presentation with you. The other area to be mindful of is that the IRS is enforcing these reports with their ESRP letters about the employer shared responsibility provisions. So if they think that employers have not been offering coverage to enough employees or have not been offering affordable coverage, this is the the punitive letter that the IRS is sending. Now, currently, I've seen that they're auditing compliance with, well, I wouldn't say 2018 anymore. I think it's all 2019 provisions of the ACA. So the letter may be mailed to employers informing them of their failure to comply with either IRS Section 4980HA or B provisions. and the employer generally gets 30 days to reply, and they either agree and pay the penalty or part of the penalty. But if they don't think they owe the penalty for whatever reason, then they need to appeal it. And this is one of the services that Hub has been providing on behalf of their clients, is at least in this initial informal appeal phase, we have been helping several clients with their appeals of these letters, because these, again, the penalties can multiply and actually balloon fairly quickly, depending on the type of violation. The first thing, again, that we always tell employers is that they can request an extension with the IRS to appeal the decision. So they would just need to fax the request. Hopefully everyone still has a fax that can work in some capacity. But there is a fax number on the upper right-hand corner of the letter. As long as the request is sent in before the deadline, they should be granted a 30-day extension to appeal the decision. And the other thing to bear in mind is that these letters are going to question if a plan is deemed to be affordable under the ACA, and it may have different codes in a form. It's called the Form 14765 that would list which employees' coverage they have an issue with. And that are those areas and those employees' coverage is where the employer would need to show proof that the plans were deemed to be affordable. Now, here's some areas that can trigger the 226J letters based on just common mistakes employers may make. Sometimes in filling out their Form 1094C, they may say no, that minimum essential coverage was not offered to 95% of the full-time employees. You don't want to say no. You want to be able to say yes for the entire year, or they're going to say, oh, you didn't even offer coverage. It wasn't even expensive coverage. You didn't offer anything. And that is the big penalty, where it is charged, it's a smaller employee penalty, but then it's multiplied by all the employees, regardless of whether they were offered coverage or not. So that is one area where you want to make sure you're at least covering your bases. Another one is on the 1095C form, where you leave codes indicating if an employee was offered coverage and what the safe harbor is. Sometimes people leave it blank. It's possible and oftentimes acceptable to leave it blank if like no coverage was offered or the employee doesn't take the coverage, but sometimes that's interpreted as the employee should have been offered coverage. So you'd want to put in a safe harbor if possible, and those are usually codes 2F, G, and 2H. Other areas that can trigger enforcement letters is information not matching what's in the employer filings. And the main example of that is actually the next example. Not IRS mistakes. This is distinct from that. If an employee declines coverage that they were eligible for, but goes on to exchange coverage instead and receives a premium tax credit for the coverage that they were not qualified to receive, that automatically triggers a letter to the employer. So it's somewhat counterintuitive, but what's happening is oftentimes employees will opt for exchange coverage even though they're no longer eligible for it. And even though, there's really not much of a mechanism in place to stop them from obtaining it. And so as a result, it's seen as the employer not provide, or the employer coverage must have been too expensive if the employee did it. So essentially, it's the employer's job to prove that they did everything right. Now, note that this doesn't mean the employer had to offer cheaper coverage than the exchange. It just needed to be affordable under the ACA rules and prove that it was actually offered to this employee. And also, I will say that for the most part, I don't know that employees are necessarily being devious. I think they just don't realize that they're not allowed to be on exchange coverage if they're offered employer coverage. And this is just a nice smattering of scary penalties through the years for your reference that you can use to scare yourself or your clients or your coworkers to get this right. Again, the A penalty, though it looks smaller, it's the one where it's multiplied by all the employees. So in this case, it may be 2,800 times 30. Whereas the B penalty for affordability, let's say something was miscalculated and it showed as unaffordable when in fact it was affordable, then the potential penalty would only apply to that one employee. But it's important to note that these amounts have gone up significantly over the years, and there's no reason to think this won't keep happening.
Cool.
Okay,
Oh, real quick.
Oh, yeah. Mhm.
So are most employers using a vendor to help with the 1094, 95 filing? Because I have been referring many of my clients to vendors
Yeah.
to help with this so they don't run into these issues.
Yes.
Yeah.
Yeah.
Okay.
I mean, for the most part, yes, that is exactly what we're seeing. Or their payroll service may have it built in, like say if
Okay.
you're using ADP or something like
Yeah.
that.
Cool.
So some of that, yeah, for the most part, it is a vendor that's doing it. And there are some vendors that are especially equipped to do back filings or correct mistakes. So, they are all expanding in all the directions that appear to be needed or where they see an opportunity, if I'm more cynical about it. So the transparency rules, these are new rules that came into being under the Consolidated Appropriations Act during the height of the pandemic. And they're sort of designed to provide more transparent information about insured plans and self-insured plans and how to access care, how much care costs, other information that can sometimes be hard for participants to come across. So a lot of it is a bit hyper-technical or are things that the employer would already be addressing. So I will just kind of give a summary of some of these areas. One of them is provider directory updates. While I know plans do this anyway, they are now actually required to update the accuracy of their provider directories every 90 days. And within 2 business days, update when they get an update from a provider, correct it within 2 business days and respond to requests within 1 business days. Continuity of care. There also needs to be a warning to notify patients if they're receiving continuing care with the provider and that provider's contract is about to terminate. Another area that has been new has been producing new ID cards that include particular information on them. I mean, again, ID cards are nothing new, but now they have to add specific information to those cards, namely deductibles, out-of-pocket maximums for both in and out of network coverage, and phone and web address information. So it's sort of things that, I mean, I think outside of deductibles and maximums, we were already seeing these things on cards. And I don't know, if it's just an ID card, this is going to be a lot to fit in one small document, but now it's actually required. And this would have began for plan years beginning on or after January 1st of this year. The other area that is most pertinent for plans themselves, not so much for participants, though in theory it's for participants to access, is access to machine readable files, which sounds very exciting, I realize. Basically, any non-grandfathered plan needs to publish on a public site their group health plan medical service rates and pricing information that participants and beneficiaries can access. And this is really information it's supposed to be medical information. It's not necessarily supposed to be publishing plan information publicly, but I know that's in a lot of ways that's what it amounts to. So they'd be publishing their in-network rates for covered items and services between a plan and an issuer, and out-of-network historical payments to and charges from out-of-network providers. Now, the other area that needs to be published is prescription drug information. That area was delayed, but in a second, we'll get to the new prescription drug reporting requirements as well, where in-network negotiated rates and net prices for all covered prescription drugs by a plan or issuer at the location level also needs to be reported. Now, for the most part, for fully insured carriers, they're taking care of this machine readable file posting requirement themselves. For self-insured plans, a lot of the insurers or providers were providing links to their own information or helping them create a site where they could post the list of information themselves. So if this hasn't been dealt with, then a group would want to make sure that their self-funded and level-funded plan is complying with the posting requirement. Another area that is coming up is a self-service explanation of benefits estimator, where plans would need to provide access to a self-service tool that would contain that pricing information for plan items and services. So I think that is kind of a change in that usually you get your EOBs after the services occurred and you find out what the damage is. Here, starting January 1st, for plan years that start on or after January 1st, they need to be able to have access to this EOB. And this document would need to include an estimate of the cost-sharing liability for the item or service, the in-network rate for in-network providers, and then the out-of-network rate allowed for the covered item, when a bundled payment arrangement is available, and whether there's any prerequisite for the covered item or service, and any other caveats that might go along with the pricing information. Now, actually, there was an advanced EOB requirement, but it turns out that is actually suspended until further notice. The other area that actually will not be so pertinent to you all is that you'll need to get a services compensation disclosure from brokers and consultants. It is pertinent actually in that the broker will need to be providing it to you, but it's not something you actually need to put together. The broker would need to be preparing and delivering a compensation disclosure to a plan fiduciary on or after December 27th, 2021. And the disclosure would be presented prior to the broker engaging with the group to perform services or at any renewal or extension of that relationship. Now, a lot of this information is provided if a group is reporting through their Form 5500, but it's not exactly the same. It's laid out differently. It's provided in advance of the contract, and it would apply to all ERISA covered clients. So you should note that if you do not receive such a disclosure from a broker or a prospective broker, then you should request one. And if you don't receive it, you could actually report that broker to the Department of Labor to avoid a prohibited transaction. Prescription drug reporting. This is kind of the big one that's lying on the horizon because this applies to all plans, regardless of size and type, really. Grandfathered, non-grandfathered, self-insured, level-funded, and fully insured plans are all reporting prescription drug and health plan cost information to the three agencies, and the deadline is December 27th, 2022. Exemptions do apply, however, to other ERISA-covered benefits such as HRAs and HSAs and health FSAs that are technically seen as ERISA health plans but aren't subject to prescription drug reporting because they're not the plans actually providing prescription drug benefits. And in general, you'd be providing, plan information, employer premiums, and 50 most prescribed drugs, the 50 most expensive drugs, and the drugs with the most year-over-year increases in expenses, as well as any rebate information that a group is receiving. So all the plans will be submitting a plan list and then 8 separate data files and a narrative response for this reporting requirement. And they're all kind of addressing what I was alluding to before. Now, in the case of a fully insured plan, that is most likely going to be covered by the carrier, depending on the vendor. But if it's a self-insured plan, then you'd want to be working with your TPA to ensure that they are taking care of this for you. Now, this information is reported through the prescription drug reporting module that was created in the Health Insurance Oversight System of CMS. So I think it's called HIOS. We're not entirely sure yet. If the reporting entity would need to get onto the CMS portal and create a HIOS number. And as Darcy reminded me earlier today, if a group needs to create a number, they should do it soon because it can take 2 weeks to get that information back in order to be able to report the data on their system. So if a TPA or a pharmacy benefit manager or carrier is going to be reporting on behalf of a group plan, then the plan is not required to go in and create an account. But if they're only handling a portion of that reporting, and we're seeing plenty of TPAs and PBMs who aren't necessarily taking on the P2 part because they're not going to know necessarily, say, the employer-employee premium breakdown, for example, it's possible that multiple entities are going to report on behalf of a group, and for that reason, the client may need to go in and get that HIOS number. So they would want to do that soon, so there's ample time for turnaround and getting the number and reporting their information. So again, a group will want to contact their PBM or TPA to see if they're going to assist them if they have a self-insured or level-funded plan, and also ensure that their fully insured carrier will be covering all the reports for them. And after they determine what the requirements the employer will have to deal with, they'll create an account so they can comply with the requirements by December 27th. And we have another link for the CMS reporting instructions. Another area where the transparency rules created more reporting is air ambulance reporting. Again, I think this is sort of to see statistically forcing service providers to disclose what they're charging to plans and to employers. Basically, group health plan and carriers need to report information on air ambulance services and costs to HHS and the Secretary of Transportation, and basically show whether it's emergency or non-emergency, if it's part of a hospital program or municipal program, rural or urban, the type of aircraft, and whether they have a contract with the carrier. So I think, again, because this is one of the areas where the surprise bills is most prevalent, this is one area where they want to track the prices specifically. And the No Surprises Act itself is another area that's talking more about surprise bills. It kind of overlaps a bit with the transparency rules that we were talking about before, and actually provides other mechanisms for challenging bills that one would think did not jive with the No Surprises Act requirements. Basically, for January 1st, 2022 onward, for providers and plans beginning on or after that date, it was to protect participants from receiving surprise bills from out-of-network providers and requiring more money from the patient after the plan has paid its part of the bill. So a health plan or carrier must apply the in-network rules for a prior authorization and in-network cost sharing for a patient who receives emergency services from an out-of-network provider, non-emergency services from an out-of-network provider at an in-network facility, or out-of-network air ambulance services. So essentially, with these areas where something emergency or ambulance-related sort of activities may occur, and it may occur out of network because one does not have much control over the location when that occurs, this is ensuring that these are going to be charged at in-network rates. And it applies to insured, self-insured, and level-funded plans across all states. And this basically is stating that the participant's expense is going to be capped at the in-network provider reimbursement cost. And on top of that, should a bill not be following the rules, it also has a dispute resolution process if the plan or the carrier and the provider cannot agree on the qualified payment amount for the services rendered. And those provisions actually extend to grandfathered plans as well. So if you're a self-insured or level-funded plan, you would want to confirm that your TPA is including the No Surprises Act notice with any explanation of benefits they may receive, posting the notice on their website, and including it in any updated summary plan descriptions or other plan documentation. And confirm that the TP is going to account for the independent dispute resolution process, that they know what the cost of services will be if it comes up, and that they've formalized definition of what the qualifying payment amount will be that would be used for out-of-network providers. I haven't seen much in the way of activity on this front. I know that it was required to be implemented already, but in terms of actual disputes being occurring under this act, I don't honestly know how it's going. But in terms of what an employer is responsible to do, these are the areas where they will want to make sure that their plan language is sufficiently addressing the new requirements of the act. Okay, I wanted to spend a little bit of time on the Washington paid family leave. Let's see, never mind, I'm sorry, I was thinking of another area. Just a reminder that in March 22, the state legislature amended its PFML Act to add to bereavement leave for the loss of a child. So subject to the regular maximums and minimum benefits and other durations and limitations, an employee is eligible for up to 7 calendar days of family leave in the event of the death of a child, if they would have been eligible to bond with or were bonding with the child. And leave is also available for up to 7 days from the date of the child's death. There's also a clarification of the postnatal period under the Washington Paid Family Leave Act. Basically, it was provided to note that postnatal period is defined as the first 6 weeks after birth, and any paid leave benefits that's used in the postnatal period must be medical leave unless it's fully or partially exhausted prior to the birth of the child, or if the employee chooses to use family leave during the postnatal period, and also that certification of a serious health condition is not required for paid leave benefits that are used during the postnatal period. They also included an exception for the collective bargaining agreement. The exception for collectively bargained agreement benefits has an expiration date that's now set. The requirement previously did not apply to employees who were subject to a CBA that was in existence on October 19th, 2017, until it was renegotiated or expired. But now the amendments to the PFML Act call for the expiration of the CBA exception as of December 31st, 2023. So it is a bit of notice that any CBA groups, the exception to the paid family leave requirements will expire at the end of next year. Now, I was also going to discuss Oregon paid family leave, but I have the feeling that is not going to apply to too many groups here. So I think I will just skip over that. Oregon's is a bit longer. The other thing we wanted to touch on is what to expect in 2023. Just, like you don't have enough on your plates already from everything I was talking about. One big one, of course, for Washington State is the Washington CARES Act. As you know, December 31st, 2022 is the last day to file for an exemption with the ESD to be excluded. And there will be an exemption accepted by the ESD for groups that did not previously qualify beginning on January 1st, 2023. It used to be an exemption was just simply when you filed in advance, but now, given how the CARES Act has been modified to allow for other issues so that people who may not necessarily benefit from the rule don't have to pay into it, those exemptions are now available to employees. So if someone's living out of state, but working in state of Washington, you can apply for exemption, as well as someone who is doing so with a non-immigration visa, working temporarily in the state. Note, you would not qualify if your non-immigrant visa status changes and you're a permanent resident or citizen in Washington. If you're the spouse or registered domestic partner of active duty military member, and you may be able to get an exemption on that basis. And last, if you're a veteran with a 70% or greater service-connected disability, you must be rated with U.S. Department of Veterans Services as having a disability of 70% or greater. And so all of those make you eligible for an exemption from the Washington CARES Act tax that would go back into effect on July 1st, 2023. The other thing to bear in mind is that you're required to notify the ESD and the employer within 90 days if you no longer qualify for your exemption. Now, it is kind of on an honor system, but, and I don't know on what level the ESD would be able to audit this, but it does state in the changes to the law that the failure to notify the ESD of the, a change to your exemption status within 90 days would result in payment of any unpaid premiums that were due and interest as well. So bear in mind that the July 1st, 2023 date is when employers will begin, they will reinitiate the collection of the Washington CARES Act tax, and July 1st, 2026 is when the act becomes payable to those who are eligible to receive benefits. In addition to this, there are other areas on the horizon, some of which we've touched on a bit today. The Mental Health Parity Act and Equity Act civil monetary penalties are on the horizon for those whose mental health parity audits may not show parity between the mental health and substance use disorder benefits and their medical surgical benefits. The transparency rules will have disclosure and reporting, such as the prescription drug benefit rules. The update to the affordability calculations to include family coverage, another cap to the affordability safe harbors, and as I touched on earlier, a possible extension to the emergency declaration and separately the public health emergency. So there's a lot that's on the horizon. Oh, and the exchange subsidy expansion may also lie on the horizon, though we don't know exactly to what rate yet. So there are a bunch of things, as I said, that people will have to be keeping an eye on for 2023. These are areas where we provide updates to our colleagues, either in a client-facing mode or internal only, that can be repurposed so that our team can keep everyone abreast of these regulations. But that is basically all I have for you today. Again, I know this was fairly in-depth, but I didn't want to get too much in-depth since, I don't know to what degree this is affecting everyone right now. But that is our presentation.
Thank you, Sonya. That was very interesting. And just as I see the Q&A slide, so we are here for questions now questions later, Amanda knows how to get in touch with me if those of you listening don't. And I can always pass questions on to Sonya and Darcy as necessary.
Absolutely. Thank you all so much for coming today.
You're welcome.
So much information that businesses need to know. I want to remind everybody that RCAW has our annual membership dinner with Speaker McKay Daniels, CEO of the NRCA, on Friday, October 21st at the Hotel Interurban in Tequila, as well as the Pacific Northwest Regional Women in Roofing Day coming up on Saturday, October 22nd, also at the Hotel Interurban. We'd love to have everyone come out for an amazing networking opportunity and meet our new 2023 Board of Directors, as well as enjoy a day dedicated specifically to women in roofing. Please register on our website at www.rcaw.com. See you real soon.